All right, cool. See people coming in. Let's kick this one off. Jogundas, you've got the mic. Let's check that. How you doing?
Hi there, doing well. Can you actually hear me?
Yes, I can. Yeah, loud and clear.
That's great. How are you doing?
I'm doing well. Yeah, it's thanks for meeting today. I know it's getting a little later in Europe, and I'm really glad we get to have this conversation and talk about Hoyu. It's I'm super excited about this. I've wanted to bring you on to do a Twitter space for a long time now.
Oh, sounds great. Thanks a ton for having me on. I'm always excited to talk about Hoyu, so a real pleasure.
Yeah, it shows. I mean, that's awesome. I'm really excited. So yeah, I have kind of a loose template of the things that I want to ask you about, and we'll kick it off here, and then if the audience has any questions or feels like anything needs to be clarified, they can just raise their hands, and I'll be periodically checking to see who's got a hand raised for clarification questions. But I think at the very least we'll open it up at the end for audience questions. But yeah, so let's start this off. I want to first introduce you, share a bit of how I met you. So Jogundas spoke at ETH Prague in June this year, or last year, I guess, 2024 now, and spoke about the problems of money markets, of traditional of lending markets in crypto, and talked a little bit about the high level of what a solution would look like, which in the background is Hoyu that he's been working on for I want to say a year now, but that maybe you can tell me a little bit more about that. But I was really impressed at your Prague talk, and I went through it three times after watching it in person, watching it online. So it's really fascinating, and the thing that stuck with me is just you had articulated some things that I hadn't been able to put words to, which is like the need to get away from oracles and DeFi, and that speaks to this trend that we're now seeing of oracle-less DeFi protocols. So it's kind of introduction on how I know you and my understanding of the high level of Hoyu. But maybe you can start by introducing yourself, talking about how you got into crypto, and maybe share a bit about your crypto journey.
Sounds great, and thanks a ton for the super kind introduction. I mean, you must be the person who has seen this talk, this obscure talk of me in Prague for the most times by far. So the way that I started in crypto was actually, maybe very simple. It was more than 10 years ago by now. I think I saw some post on Slashdot or something, which led me to read the Bitcoin white paper. And then I kind of stuck around for quite a bit of time, talked to a bunch of people in different forums. So Bitcoin Talk was one of those forums, I guess. Maybe some of the old timers even remember that. It's still up, but I think it's way less active than it used to be. So that was the very start, and then afterwards, I also was interested in various different protocols. For example, colored coins were kind of picking up at some point. This is, of course, ancient history because Ethereum was not a thing back then. And once the Ethereum white paper came out, I tried to kind of read it very carefully. I made some notes, suggested some improvements to the team. So that was the very start. And well, I mean, I did different things during these 10 years. I was a research scientist doing theoretical physics. Then I had a startup in the artificial intelligence and healthcare space, which I successfully exited. And now Hoyu is the main thing that I am working on.
That's incredible. That is quite the resume. It sounds like you've worked on a lot of highbrow projects. Really theoretical physics. Did you say you got was it a PhD or a master's in that, or you studied that in undergrad and then went into AI?
Yeah, I got a PhD in physics, and then I kind of got my own funding as well to do the research that I wanted to do back in the day. And this was really fun. It's it's a bit lonely to work in theoretical physics because in principle the only thing that you need is a like a notebook and a pencil. I mean, people work with computers. I did as well, but in principle, that's kind of all that you need. And it's very interesting work. But at the end, I decided that I want to do something that is more impactful in the short to midterm, and that's kind of the reason why I was interested in crypto, but also in business in general.
That's incredible. And I didn't quite know the extent of your physics background, but I'd imagine that that transfers to crypto. I think the brilliance and the elegance shows in Hoyu, and that's something that we'll get into. So with that background, um, on yourself, maybe you can give a background on Hoyu, and first maybe I'd like to introduce Hoyu as a concept. Like, what is Hoyu?
All right. So maybe a good point to start is kind of the DeFi space at large and what people do with DeFi. So I would say that there are two things that have a product market fit, if you want, but like that people use very heavily in DeFi. One is trading tokens. So after Uniswap started, everybody can kind of create their own market for their token, and they can trade that token back and forth. So that's very fun, of course. Another thing that people apparently are interested in is taking a token, putting it up as collateral, and then borrowing, typically stable coins on top of that. I mean, there are quite a few situations where one would like to do it, and also kind of analytics show that this is what uh, many people do. Like if you look at TVLs of lending markets, they're huge, especially during bull runs. And this is somehow the intersection of trading markets and lending markets. That's where Hoyu comes in. So Hoyu integrates a trading market with the lending market and does it in a smart way, not too mechanically, but in a way that I think makes a lot of sense. And from this merge of trading markets and lending markets, you get something that is very neat. So that thing is a lending market which supports any token, so any asset in principle, as collateral, and also has other nice properties, like, for example, no bad loans, meaning that if the smart contracts are written correctly, they should keep on uh, executing the lending actions no matter what the market does. So no matter what the volatility of the collateral is or what like the people trying to attack that lending market kind of try to do. So in maybe to kind of sum up very briefly, Hoyu is supposed to be the most robust lending market that you can think of.
Wow, and I heard a lot of things there. It sounds like you mentioned the two DeFi primitives that have seen the most success in AMM and a lending market. These are two things that Hoyu fuses together, and then the goal of that is to allow borrowing against any collateral of a stablecoin and the prevention of bad debt. So in the Hoyu system, as I understand it, bad debt is impossible to create. Um, and yet at the same time, people can borrow against any arbitrary altcoin. They can borrow a stable coin.
Yeah, that's absolutely right. So um, yeah, so maybe let's leave that here at there. I mean, of course, we could also talk about how other lending markets work, like what is the role of all oracles and liquidators. But I don't know if you want to go into that direction at this
Sure.
point.
Yeah. I mean, so maybe I could recap a little bit for the audience, like your DeFi Prague talk. The takeaways that I had were that there are two problems in DeFi lending markets. The first problem is the question of liquidity. The question is, how do you know that the asset that you're listing or you're accepting as collateral is liquid enough that you can accept the spot price for the asset and apply it to all the collateral? Meaning, put another way, or illustrated with an example, the Curve, the large deposit of Curve by the founder of Curve into Aave was a problem because while all the Curve was marked at, was around $1 each, 50 million curve is not necessarily worth $50 million. There's a liquidity crisis that happens there when you have half of the circulating supply deposited and borrowed against in the lending market. So the first question that I walked away with that is a challenge for lending markets is how do you guarantee the liquidity of the assets that you're accepting as collateral? Second question is the oracle problem. And so the oracle problem is how do you know that the price an oracle is giving you is actually the price? How do you know the oracle isn't changing it for their own benefit? The oracle, the data provider, isn't changing it for their own benefit? Or how do you know that they aren't fooled in turn and manipulated somehow on the back end where the prices that they're looking at are incorrect? These are the two questions that it seems like Hoyu has a solution to. How do you think about these two questions, and how do they apply to the Hoyu solution to the lending market problems?
Yeah, that's a great recap. So I think that these two questions are very intimately related. So for example, if we start on the liquidity side, the ultimate question that any lending market poses is like, if somebody brings this token or this asset as collateral, how much can I lend them? And when do I liquidate this loan? So these are kind of fundamental questions. They're not like DeFi. They're not new questions that DeFi invented. Your bank will probably ask you the same questions if you go to your bank and try to get a mortgage. But in DeFi, they're still very relevant just because all the assets, or at least a large number of assets, a large fraction of assets in DeFi are extremely volatile. So their prices change quite rapidly, and this can happen like uh, completely unexpectedly. So for example, if some protocol gets hacked, their token probably drops a lot, and the lending market has to be able to react. And they should be able to react rapidly to these price changes. And that's where the price oracle issue comes up. So oracles have to be very fast just because they're the only information source that the lending market has. So a lending market typically is a smart contract on some blockchain, and the smart contract, I mean, doesn't know anything by itself. It doesn't know anything that happens in the world at large by itself. So that's why they rely on oracles. And typically, these oracles only do provide them with price information. So the lending market gets spot price, meaning the price of this collateral asset at that point in time. And that's about it. They have a single number every period of time, and that's what the lending market has to operate with. So uh, to recap again, the lending market has to know if the collateral covers the debt, and this is happening through this very harmonious interplay between oracles, liquidators, and the lending market kind of smart contract. So if any of these actors stop behaving properly, the lending market is immediately in trouble.
This sounds like a really elegant solution because I think what you're describing is the AMM feeds the lending market prices and liquidity information. So it gets around those external dependencies that other lending markets have.
Yeah, that's right. So what I had described was how a traditional lending market works. So they have these oracles, they have these liquidators, and I mean oracles and liquidators, they don't live on chain. They are some actors or like software that is off chain. But in Hoyu, this is handled completely differently. So in Hoyu, there are no oracles, no oracle dependencies. There are no liquidators, so there are no external actors to kind of pay off to watch your loans and decide if and when they go back bad. And I mean, that's a completely different system, which does not rely on these kind of external components that the lending market itself can't control.
So you said it's not possible for the loans to go bad. How does that work?
Right. So in Hoyu, as we mentioned at the beginning, there are two basic building blocks: the DEX or the AMM. So that's where the trading happens, and the lending part. That's where the lending and borrowing goes on. So the only time where a token price changes, I mean, that can only happen if somebody is trying to swap one token for another. So if I'm like selling some token, its price is going down. And in Hoyu, this swap action is one of the actions which sends information to the lending market. So if I'm swapping a token on the trading market side, this price information, the fact that the price has changed, goes directly to the lending market. And the lending market is smart enough to look at the new price and to decide if this new price is okay or not. So if it's not okay, the lending market will first of all liquidate the collateral that is backing this loan, and only then does it allow to proceed with a swap. So that's like one of the situations where the interplay between the AMM and the lending market leads to a liquidation of a loan which would otherwise have gone bad.
Okay. And so, and you said, I think the way you worded it is that the lending market is smart enough, but I'm guessing that all happens in the smart contract logic rather than a group of keepers or something like that. What does that look like? How does the lending market decide whether a loan is bad or not, or about to go bad and prevent it?
Yep. So that's again a key question. So everything indeed happens in smart contracts, and basically the lending market smart contract has to always be aware of liquidity levels. Like if I sell this collateral, how much money will I get for it? So that's what the lending market has to know. And this relies, of course, on the price of the asset, but the price is not the only dimension that it has to take into account. It also has to take into account the liquidity level, or like the LP uh, level, if you want. And I mean, with each transaction, this lending market smart contract has to evaluate, like, after this transaction, will the liquidity and price be still sufficient such that all of the loans that are outstanding, that they can kind of still be considered good loans? And if not, the lending market has to immediately take action. So there are no keepers involved, no oracles involved, and all of this happens inside of a smart contract logic.
That's awesome. So basically, the AMM feeds information about liquidity and I'd imagine price into the lending market so that the lending market knows if the price goes down, then there are going to be loans at risk because they have a certain loan to value ratio, right? That can't be deviated from, or can't, you know, people's loan to value amounts can't go above a certain threshold. So what is that? What do those parameters look like in the system? Like how does it compare to something like Aave or another lending market in terms of parameters for loans?
So in these more traditional lending markets, the only parameter that you will find is loan to value. I mean, in some lending markets, you might find some more exotic parameters, maybe like classifying tokens into, I don't know, tier one, tier two, and so on assets. But at the end, it kind of boils down to loan to value. So loan to value means that if I have, I don't know, let's say some Pepe token, which costs like 1 cent per token or whatever, and they have like 100 Pepe tokens as collateral. If my loan to value is 1, then I'll be able to just borrow $1. And if loan to value is lower, if it's like 50%, then I will be able to only borrow 50 cents on that collateral. So that's like what loan to value means. I mean, this again is not some thing that the DeFi degens invented. It did exist in TradFi as well, and it just means like, how risky is this collateral? It basically tries to take into account the fact that when selling collateral, you will most likely not get uh, like 100 cents on the dollar. You will probably get less. And that's the reason why loan to value in these more traditional protocols is typically not too high. So you can see LTV values anywhere in the range of 50% to maybe 80% or so in these more traditional lending markets. like I don't know, like Aave and Compound. In Hoyu, there is a concept of LTV as well. This LTV is fixed for all of the assets. It's fixed at 90%, and it might be kind of exotic or interesting to mention that the reason why the LTV is not 100% in Hoyu is a little bit different from how it works in these other situations that I just described. So basically, the thing that is going on in Hoyu is that um, you have a certain liquidity level on the AMM side. So if you liquidate any amount of collateral, this will mean that the price will drop just because the liquidity is finite. And if you want to kind of avoid very large price drops due to loan liquidations, you should just limit both the LTV of the loan, but also like the amount of loans that can be borrowed on a particular collateral asset. So the ideology is a little bit different in Hoyu versus more traditional lending markets, but the concept of LTV is there with a interesting difference that in Hoyu this LTV is very, very high. So it stands at 90% even for very strange and very illiquid tokens.
That is really interesting, and I guess the key there is that bad debt is impossible. So where 90% would be potentially dangerous for Aave, if their collateral were to drop 10% or 15% in a day, they'd be left with bad debt. But because that's not possible in Hoyu, the 10% margin there is acceptable. It sounds like, and maybe another way to think about it, tell me if you see it this way as well, that um, that 10% margin in Hoyu is there so that there is something to borrow, right? Because without an over collateralization of some kind, then there isn't actually anything that people can take out against their collateral, right? If there's 100% LTV, then that's just a trade. Um, so, yeah.
Yeah, that's a very good way of thinking about it. I mean, so when constructing a lending market, you don't want to end up in a situation where people instead of kind of selling their token, maybe let's use like Pepe as an example again, instead of dumping their Pepe for USD on some trading market, on some DEX, you don't want them to come to your lending market and try to kind of do the same, but with a lending step in the middle. So that indeed would be the case if somebody took loans for like 100% LTV, and Hoyu does not do that.
Right, because it would be instantly liquidated, is what you're saying, I think.
Right, right. Well, I mean, there are kind of many ways to talk about it, I guess, but like instant liquidation is one, a trade is another one.
Sure.
Having like zero availability of loans on that asset is maybe another way to also state more or less the same mathematical
Mm.
fact, if you want.
Right, for sure. Okay. And so to clarify this, we've been talking about Hoyu as one sort of entity. What does the architecture look like? Like there are presumably there are multiple pools, and then Hoyu is not just an AMM that you're borrowing from. It's an AMM that's sort of plugged into a lending market. Can you speak to that sort of architecture?
So it's kind of hard to describe visual things in words, but I mean the architecture is not that complicated if you want. So it's very similar to how older versions of Uniswap work. So Uniswap v2, for example, and the architecture is that a user might come to the factory smart contract, which is a smart contract that manufactures AMM and lending market pairs. So each AMM, each token pair, so for example, Pepe USDT could be an example. So Pepe USDT would be something that the user kind of types into the factory smart contract, and then the factory smart contract spits out a couple of new smart contracts. One of them would be the AMM part, another one would be the lending market part for that particular token pair. And then after this happens, basically there is a new lending market for this particular token pair, that the users, all of the users, can permissionlessly interact with. And I mean, that's the architecture. So basically, each of the AMM lending market pairs, each of those are independent. I mean, they were created by the same smart contract, by the factory smart contract, but they're completely isolated from each other. They don't really interact one with the other. And this, again, kind of guarantees that there is no contamination. So if somebody, I don't know, does something bad or mints a scammy token and then tries to create a lending market for it, this is completely independent from how all of the other tokens interact with their respective lending market contracts, if that makes sense.
Yeah, and it makes sense that it would be that way. You know, it's siloed rather than cross margin, to minimize the contagion between, potential bad debts that would be created in another lending market. But here, it makes sense that pools would be distinct from one another. So maybe you could walk through. First of all, before I'm going to ask you next to walk through maybe an example of a borrow from a borrower's perspective. But before that, I am very curious. How did you even come up with the idea for this? Because this is so out there, and it's like, it's it's so obvious. It's like, oh, of course you solve these two problems, but the way that you've done it just seems very unique. How did you come up with the idea for Hoyu?
Well, I mean, I kind of looked at various protocols. This was maybe several years ago, maybe 2 or 3 years ago, and I was really disappointed that there were not too many, um, you know, truly decentralized and truly permissionless protocols that people used. I mean, I kind of assumed in advance that most of the DeFi protocols would be just completely decentralized, meaning that there is a smart contract and it does its thing, and that's about it. But it turns out that this is not the case at all. It is the case with Uniswap to a certain extent. I mean, they have a fee switch, but besides the fee switch, there is nothing that the DAO governance can do to the older versions of Uniswap. But besides Uniswap, it's really tough to find immutable smart contracts. I mean, there are several protocols, but that's rather an exception and not the rule. And I had assumed that lending markets work this way, that they have some connection to the AMM, and that's how they kind of do their thing. But after studying how Compound and Ava works, I kind of realized that this is not the case. And I mean, for me, the Hoyu architecture looks very natural. I mean, I assumed this existed, and it does not. So that's the reason why I decided to kind of go ahead and try to create it. Of course, once you identify something that should kind of exist in a natural state of things, it's probably a good idea to try to understand why that is not the case. Like, because I mean, there are lots of smart people in the space, and people are exploring various ideas, trying to kind of come up with interesting products. So I spent quite a lot of time thinking of various exploits and various edge cases that could prevent this thing from working properly, and only kind of convincing myself that this can work and that this can be secure from uh, basically all of the relevant angles did I decide to go ahead and try to work it out down to the actual smart contracts.
That's really interesting. I feel like seen that a couple times where you're like, why doesn't this exist? And a lot of the time, the question is because nobody else has put the effort in, or nobody else has. I wouldn't be surprised if no one else had even thought of this. But it is really cool that the way that you've put Hoyu together to solve these problems and to create a censorship resistant protocol, because I think we're probably aligned on this, that the protocols that are not censorship resistant are probably not going to be around in 5-10 years. Like, I wouldn't be surprised if Aave sunset at some point because of all of the um, exploit vectors that there are and the cost of maintaining the protocol. They might be profitable enough to, and they probably are profitable enough to maintain the system of governance that they have, but it's extremely costly and time intensive to constantly be updating parameters to prevent exploits of lending markets. And luckily, it seems like Hoyu doesn't have that problem. So, yeah, go ahead.
Just maybe if I can react to this, I mean, I think I'm a little bit more generous than you are. I think that the market has different segments, and I mean, I think that these let's call them semi-centralized protocols have their part. I mean, they're serving a part of the market where people don't really care about this decentralization, and more crucially, where the volatility of their collateral asset is low. So I am not surprised that Aave is accepting Ethereum or Bitcoin as collateral. These assets have very deep markets relative to other assets, but I am completely unsurprised that they're not taking like Pepe or other like I don't know meme coins as collateral, just because these are super volatile. Nobody knows who controls the liquidity, and the liquidity levels are typically not that deep.
That is very fair. I think I have a rather pessimistic view of DeFi in the next few years, and I guess to me it doesn't matter if Aave, um, if Aave is around and requires KYC or if it sunsets. Those two, in my mind, are the same. Because I think DeFi, it's axiomatic. DeFi is decentralized finance. But I guess I tend to have a little more bearish view of regulation and things like that. But those are very good points. So the next question that I wanted to launch into, you mentioned a bit about security assumptions. I want to get to that next, but before doing that, I wanted to ask about what the flow looks like from a borrower's perspective. Like, if you could walk me through the steps of borrowing and who's involved in that process, and how the AMM is used.
Right. So, um, okay, again, maybe let's use the same tokens for concreteness. So you're a person who, for some reason, has a bunch of Pepe, and you want to borrow USDT using that Pepe as collateral. So what you have to do is you have to interact with the lending market smart contract. You can do it either directly or through some front end, and you have to deposit this collateral into this lending market smart contract. Once you do that, the lending market knows that that this particular wallet has a position, has a bunch of collateral in the smart contract, and you're able to kind of get a loan using this collateral. So in the process of getting a loan, you should specify what LTV is acceptable to you. So for example, you could maybe be very adventurous and try to get a loan at 90% LTV, which then means that if the price of your collateral drops even a little bit, you will be liquidated. Or you can try to be very safe and get, I don't know, a loan at 50% collateral, and then the price of Pepe could go down by a factor of 2, and you would still be okay at that point in time. So in this process, you're interacting with the lending market smart contract, but the lending market is, of course, also talking to the AMM, trying to understand what the price is at that point in time, because the spot price is what it needs to understand if the LTV is still acceptable or not. Basically, trying to evaluate what your collateral is worth and if the loan that you're asking it for is all right.
Okay, so people are depositing their altcoin as collateral at whatever ratio. So it's not that the borrowing ratio is fixed at 90%, but the max borrow is at 90%, it sounds like. And then they're borrowing a stable coin against that. And what are they borrowing stable coins for? Like, how do you see Hoyu's product market fit, or like who are the groups of users in Hoyu and why do they want to use the protocol?
Well, I tried to kind of do some anthropology and try to understand why people use lending markets at all. And I think there are at least two simple use cases. So one is leveraging up. So like you can deposit some Pepe as collateral, borrow some USDT, buy some Pepe for that USDT, again, deposit that Pepe as collateral, and so on. This way, you are able to leverage up your position, and people apparently do that. And another reason why they do that is they think that their altcoin is going to go up, but they need some USD now. So these are the two kind of use cases. So for example, I don't know, I mean, maybe I want to, or just was the case, this was the case in the Curve example that you mentioned. The Curve founder wanted to keep his Curve tokens, but he also wanted to buy a couple of mansions in Australia. So he just deposited his Curve as collateral, borrowed some USDT, and bought a few houses for the USDT that he borrowed. Probably he thinks that the CRV, the Curve token, is gonna go up at some point in time, and that's probably the reason why he did not sell the tokens outright. But I mean, we can of course only speculate on that.
This seems like it has a massive total addressable market. Like this is like all degens want to lever up on their shit coins or low market cap coins, and Hoyu is permissionless in the sense that anyone can open up a pool. So if I mean, there could just be like tons of liquidity from various shitcoin holders that want to LP and get more of that, and others are able to lever up on their positions or at least borrow them without selling. That seems like a really large total addressable market in crypto as we head into the bull run.
Yeah, I mean, I'm actually quite excited about this protocol and about its angle as a product. I think it's interesting to people, and from the discussions with various different token projects that we had, it seems that people and like token communities are really excited about getting additional utility for their token. Like it can be any utility, I think, but utility that has to do with trading is particularly attractive. And what Hoyu can give as a protocol to this set of communities is basically additional token utility as collateral. Like these you can trade these tokens, but with Hoyu you can also kind of borrow against them. And this is quite new. Nobody has experienced that before. We have seen glimpses of this in the last bull run, where protocols like Rari and Cream, I mean, got to billions of TVL even after getting repeatedly hacked. So it seems that people really do want to use those lending markets for their altcoins.
This is interesting. It makes my mind go in a lot of directions. I'm thinking about the possibility of creating a stable coin with this, but I think maybe a more pertinent question is what happens if someone wants to short? What does that look like in Hoyu?
That's a great question. So at the very beginning of protocol design, we did quite a bit of interviewing, and we came away with a product decision to uh, disable shorting. So this will, of course, be done only at the front end level. And what this means is that when you're providing liquidity on the AMM side, you are able to know which of the tokens is going to be the collateral and which is going to be the token that that your users can borrow. And this basically means that if you want to short a token, or if you want to make a token available for shorting, you will provide liquidity with this intent in mind. You won't do it on accident. And I think that what this will mean is that most of the pools will allow shorting USD, which basically means longing the altcoin, and they will not allow shorting the altcoin, purely because people apparently are very reluctant to provide liquidity, which will then be used to short their favorite token. I mean, I've heard things like if a token is available for shorting, and if it's a small founding team, a small community, you get like horrible things happening. People try to attack other people, and so on. So basically, that's the reason why we made a decision to kind of separate out the short and long aspects of lending.
Right. Like I imagine you actually incentivize rugs if you allow shorting because people can convince an entire community that their token is going to the moon and then they can put a short position on and then just rug the entire project and make money on it.
Yeah, I mean, like if we really wanted to be completely neutral, we should have probably allowed shorting. But I mean, I think that I would feel not too well doing this experiment with kind of shorting highlighted right from the beginning. I think that we still have to learn a lot as a bunch of DeFi communities, and maybe once this thing becomes much more mature, maybe then we can kind of move towards shorting by default or something. But now I think we're still very much not there yet.
And I think I like the ethos of up only. I think that aligns really well with the time that you're building this and presumably looking to launch. So I'll ask about that in a bit. I don't know if you have timelines on that, but um, one question that comes to mind as a follow up to this is how do you distinguish between altcoins and stable coins? If you're preventing shorting, I think that implies that you're making a distinction somewhere in the protocol between those two.
So on the smart contract level, there is no distinction. You can create any pair that has any two ERC tokens on either side. The important thing is that even at the smart contract level, kind of token 1 and token 2 in a pair, these are not the same. So the pair is not symmetric with respect to token 1 and token 2. So token 1 will be your collateral and token 2 will be the asset that you're able to borrow. So there is an asymmetry there, which is something different from how a typical AMM works up to now. And this is what enables to kind of distinguish what is shorting and what is longing versus which token. And I mean, of course, so that's on the smart contract level. On the front end level, this can be much more streamlined. And for example, one could imagine starting off with one particular stablecoin and just showing the pairs that have this stablecoin as an asset that can be borrowed, and not showing any other pairs to start with.
I see. Okay, so the smart contract is permissionless. It's like Uniswap. Smart contract is permissionless, but the front end is what enforces that, um, canonical distinction between an altcoin as token one and a stablecoin as token two. So basically, borrowers can borrow against their collateral if there is enough liquidity in the AMM, and if someone deposits stablecoins into a lending pool to be borrowed against for that particular collateral. Can you talk a little bit about the lender's experience and what that looks like?
Yeah, so we tried to make the lender's experience as simple as possible, because what we imagine is that there's going to be a lot of different pools which are completely isolated. So in principle, if you want to be an active lender over many different pools, you would have to manage your positions very actively, which is not typically not a thing that people want to do in DeFi. So we thought that it's very important to limit the downside that the lenders can experience, which means that as a lender, you're protected at the smart contract level from things like defaults and so on. So even in the very worst case, when somebody kind of defaults, you don't lose anything, because the smart contracts make sure that there is no bad debt. And the fact that there is no bad debt means that as a lender, you will be made whole. Having said that, the lender kind of user journey is relatively simple. So as a lender, you choose the uh, pool that you want to interact with. So maybe you want, again, to deposit some USDT into the Pepe USDT pool, and people will be able to borrow your USDT. In return for that, you get some interest. So there's an annual interest rate of 15%, which is again fixed over all of the pools at V1 of Hoyu, and that's the interest that you get. So you put dollars in, you put USDT in, and after some period of time, you just get more USDT. And if people default, well, you're still made whole. So that's kind of the lender experience on Hoyu.
Wow, right. And they're made whole because the collateral is always available to sell on the AMM, and you have some things in place that prevent the AMM or the bad debt from being created. I know you have a couple mechanisms in there that I don't think we'll have time to cover today, but things like virtual reserves and the slow burn of LP tokens. I did want to cover economic security considerations, like the security assumptions of the protocol, but I think what might be more valuable is asking the audience what they would like to know. If there's any part of the Hoyu protocol that's still unclear, would love to hear about that, either if people want to post a comment or raise your hand. I'd be happy to bring you up on stage to ask Jogundas a question, just to clarify and make sure that we're communicating the Hoyu protocol properly, because it's a very elegant protocol, and I just hope we can give a good enough picture here. But so if anyone has a question, just feel free to raise your hand or post a comment. And if not, then I will ask you about maybe some of the security assumptions, and then a couple final questions. Right, I'm not seeing anything yet from anyone, so I'll assume the audience is following. Maybe Yogandas, can you talk a little bit about, like, what are the security assumptions of the protocol? What prevents, I guess, what other features should we know about?
Well, so it depends on what kind of attacks one is thinking about. So there are many types of attacks that we have seen in DeFi, and I mean, of course, it's impossible to go through all of those in a Twitter space. But so, for example, one attack that you might think about is somebody adds a bunch of liquidity to some pool, and then some other user takes out a loan, and then the first one, the liquidity provider, immediately removes this liquidity. So in such a situation, you would imagine that the user who took a loan out, so the borrower, would get liquidated. And that's not a very good situation, because it's kind of not their fault. I mean, they saw this liquidity, they took out a loan, they put in some legit collateral, and the price of the assets maybe did not even move too much. But now, since the liquidity is insufficient, the protocol would liquidate them. So that's not a good situation. And this I would consider an attack, because in principle, one could try to profit from such a situation as this very active liquidity provider in this example. And in Hoyu, we tried to prevent this by having a longer period over which the liquidity is gradually removed. So adding liquidity is instant, but removing liquidity takes a week, and it takes two on-chain actions. First of all, expressing an intent, saying that I want to remove my liquidity, and then actually redeeming the liquidity at the end of the week. So this basically means that as a borrower, you won't end up being liquidated just because some liquidity provider changed their mind and decided to remove all of their liquidity instantly. Instead, you would get a prior warning of, say, a week, and during this week, the liquidity would be gradually going down, which you, of course, would be able to kind of watch and be alerted about. So that's just one of the mechanisms and one of the attacks that we have considered in order to make the protocol safe and hopefully impossible to exploit from many different angles.
And so imagining in that time that the liquidity in the pool is taken out immediately. So if an LP withdraws their tokens, then that liquidity is pulled from the pool, but it's not available for the liquidity provider until the end of the week or so.
Yeah, that's absolutely right. Yes.
Okay, cool. And so maybe a second type of attack, I'm imagining like if a trader wants to get cheaper tokens, let's say they're a whale of some altcoin, they could sell their tokens into the AMM, trigger a liquidation, and then cause the price to go even lower. What prevents them from doing that? Is that a viable attack?
Yeah, so that's a great question. This is an attack that we have thought about as well. And here the game would be just as you said, try to kind of move the price down artificially. So the price should be at, I don't know, 1, but due to the liquidation, it went down to zero 0.9. And this 10% is artificial in the sense that somebody will orbit away at some point in time. So in order to get rid of this attack, we have a price decay dynamic where after a liquidation, the buy and sell prices of a token are slightly different and they converge with each other over time. What this means is that if there was a liquidation just now, you are able to buy the tokens as if this liquidation did not happen. And over a period of time, um, this liquidation kind of starts being reflected in the AMM. So if this is not an attack, but an actual market dynamic, this means that, again, after some time passes, the prices, the buy and sell prices of an altcoin converge and you can trade as usual. But this whale, which you mentioned in this attack, would not be able to exploit the system and would not be able to profit from the fact that some liquidation was triggered.
Interesting. So you have like a cooldown period, basically.
That's right. That's right. So there is a divergence of prices, and this divergence goes to zero. The prices converge over some cooldown period.
Hmm. And are there other considerations, like other attacks that are theoretically possible that you thought about that are prevented somehow in the protocol, or are there like viable attacks that you think could happen, things that you're concerned about?
Well, so at this point in time, I would say that I'm pretty confident. I was not able to think of any like real threats, and also we have talked to a bunch of different, also very smart people who also tried pretty hard to come up with various attacks, and so far we haven't gotten anything that is really threatening. I mean, in protocols of this level of complexity, one of the considerations is that it your smart contract might end up in a situation where the state is so complex that to get out of that state, it would take more than the whole block of gas, for example, to kind of to move forward with a with a protocol. And this is something that we have very deeply thought about, and I think that we came up with a pretty elegant mechanism to not end up in such situation. Of course, the gas usage is still going to be much higher than a traditional AMM if you just want to do some swaps. But on the other hand, the denial of service, the gas denial of service attacks seem to be impossible with Hoyu, which I'm very proud of.
It's really interesting that you would comment on the complexity of Hoyu, because when I see it, it's like this is a super elegant protocol. I think complexity to me is where you have many different parameters that are clunky and features that are kind of band-aids to issues that arise in the basic design of a protocol. But in Hoyu, I feel like everything is interconnected in a way that weaves together really well. So I would describe it as the opposite of complex. But I think I understand what you're saying, which is the protocol could be used so much that the cost of storing the data and doing all of the many operations that are involved in Hoyu could become so expensive that it costs more to um, to fulfill those or to do those operations on Ethereum than could possibly be paid in gas. But you've got some solutions to that.
Yeah, that's completely right. I mean, even simple ideas can be implemented in a way that is not optimal. And if you do that, I mean, you will end up in trouble basically. And the reason, the kind of fundamental reason for that is that the Ethereum or the EVM, the Ethereum virtual machine, is something that only supports very simple calculations. So if you go uh, towards not optimized calculations or towards something relatively sophisticated, you will very quickly hit its limits. And I mean, of course, we have to operate with that in mind.
Okay, so we're at the top of the hour, and I want to ask one or maybe two quick final questions. The first is, how does this protocol make money? And the second, I'll get to after.
So now we have a very simple scheme where the borrower pays a 0.5% flat fee to the protocol. And that's kind of the protocol fee. That's how the protocol could be profitable and have revenue.
Okay, cool. And I asked that because we're talking about protocol design, tokenomics, and what we see with Uniswap is that they have solved for two of the three principles of tokenomics, which are the utility, the protocol utility that the protocol provides to all the groups of users, the traders and the LPs, but it has not captured a meaningful amount of value. They have the fee switch. They've barely turned it on for a couple pools, and I don't think it's likely that they are going to be able to turn it on for most pools. But even if they do, they're not actually accruing that value to the token. They're giving it to the Uniswap Foundation, Uniswap Labs. And then they also have economic security, right? The incentives of the protocol are compatible, which seems to me they are compatible in Hoyu as well. And but I love to hear that there is a way for the protocol to make money, because that means that you have all three principles of tokenomics, and the protocols that successfully solve for all three of these or include all three of these principles in their design are extremely rare. And furthermore, the censorship resistant protocols that do this are few and far between. I could probably count on one or maybe both hands the number of protocols that fit this description. So it's really exciting to me to see Hoyu doing all of these things, and I'm looking forward to seeing what's next for you. Do you have an idea of when you're launching, or are you guys still pretty far out from that?
I would say that we are pretty close to launching. I can confidently say that we will launch this year, and I think that it is very realistic to launch in the next quarter, so in Q2, so in the first half, but the second quarter of the year. I mean, we do still have a couple of steps remaining. We have to go through an audit. We have to maybe do a little bit more work on the front end side, on the marketing and business sides. But as a protocol, the smart contracts are on the test net already. They're very close to being feature complete. So I think that we can launch relatively soon.
Awesome. Well, fantastic. This has been a great space. Thanks for coming on and talking about Hoyu today, Jogundas. It's been a pleasure, and really looking forward to seeing what the future holds for Hoyu.
Thanks a ton for all of the great questions, and I really had fun. So this was great. Thanks a ton.
Awesome. Yeah, my pleasure. Thank you to the audience as well for coming on and listening, and for your questions. Looking forward to the next protocol spotlight. We'll update you guys and share that next week or so. But thanks, Jogundas, for coming on, and looking forward to talking with you again soon.